Hey guys, wanted to talk a little bit today about a company that I've been following for a number of years. Probably not a company that I would invest in today, probably not exactly the kind of company that I'm looking for, but a pretty interesting company nonetheless called Credit Acceptance. This is a lending business, so a bit of an introduction to the company. This is a lending business which lends money in the subprime auto space. So they lend basically in the USA. They once had a business in the United Kingdom, but they ended up closing that down to focus on the United States. It's a business that lends money to subprime credits in continental United States. So they were originally founded in the early 70s by a man called Don Foss. Don Foss was a used car dealer. I believe he started his own used car dealership perhaps as early as the 1960s. And of course, back then the credit markets weren't as developed. It wasn't as easy for people to get to finance the purchase of a car. And so one of the reason why he began this company, or the rationale for starting it in the first place, was that was the idea that you could give anyone a loan to buy a car, which is a pretty interesting concept to think that you can just lend money to absolutely anyone and that be a sustainable business long term. But that was, none the case exactly what he set off to do. There were a couple of innovations later on that point, but essentially Don Foss would fund anyone. And the precepts under which you could do that was that the amount that you could, the interest rate that you would charge a customer to purchase a car would be quite high. And then secondly, that the value of that loan would be backed by the asset. So you would be able to repossess the car in the event of a default, and then you would be able to sell that car on again. So you can probably, there's probably a whole bunch of holes in that kind of thesis there. If you kind of move on a little bit, what Credit Acceptance started doing was rolling out that same model to other used car dealerships. So they would say, you can come on our platform, we'll lend the money to you, and you can sell the car. The used car dealer loves that because it basically boosts their sales. And it gives them other avenues to derive some income. So in many places, and there are quite a few platforms to do this, but the dealer, you will usually earn a commission for originating a loan against a car. They like it because they can sell the car, they earn a commission, and business continues on. Like some of the people who have been with Credit Acceptance for a number of decades, sometimes they've earned millions of dollars through the partnership. So it's a pretty long-standing business. Now, just a little bit of background on the industry as a whole, the subprime lending market. Credit Acceptance essentially pioneered it, and then in the late 80s and early 90s, a number of other players joined the fray. So in the 90s, a ton of capital flooded the industry after Credit Acceptance went public as a company. They saw these, extraordinary returns that they were generating, and so that's a function of capitalism. Capital chase excess returns, and so a number of players entered the industry in the 90s, and they did not have the same operational excellence, operational understanding or execution that Credit Acceptance did, and the entire industry suffered as a whole. So in the late 90s and early 2000s, the company reformed itself to a great extent, especially when the former CEO, Brett Roberts, he resigned 2021, I believe. And he came with a few extra pieces to the puzzle. Since the founding of the company, the real breakthrough in credit acceptance's operations was that they would basically have the dealer participate in the riskiness of the loan. So this means that if somebody actually failed to repay their loan, the dealer would be penalized for that. And so, operationally, basically what happens in their two programs is that when they make a loan, credit acceptance will front them some amount of money, and then as the purchaser of the vehicle repays, the dealer participates in those repayments. And so there's like a nexus that happens there where everyone's incentives are aligned. Obviously, the dealer can sell more cars and participate in earning fees for originating the loan. But also the dealer is not going to sell the buyer a lemon. The continental United States is a little bit different from large Western economies kind of elsewhere in Europe, the United Kingdom, certainly parts of Australia, even though Australia is a large country, almost all of the residents live in a large city. It's very different in the fact that it's very spread out. So if you ever go to the United States and you're trying to get around, it's not super easy to get around via public transport or to walk places if you live outside of like New York City or perhaps another large metro like Los Angeles, something like that. You basically need a car to operate in civilization. You certainly need a car if you're going to get a job. So the dealer is incentivized to sell the car. The purchaser of the car is very incentivized to repay the loan because they need this car for their job. That's the usual setup. And credit acceptance gets to align those interests based on lending the money, making the car available. So that was one of the initial breakthroughs. And the second breakthroughs that came during the Brett Roberts era, and I believe he took over in the early 2000s, was that all the loans would basically be measured on a value of economic value add. So they're very methodical about how they lend money and the returns they want to see on that money. And so that was a way for them to basically gauge how profitable a loan would be. And then you can make decisions from there. So I'll get into some of the other setup about the companies, but that was another breakthrough they had in the early 2000s, which made them a lot more operationally disciplined about how they lended money. And that was part of their competitive advantage as well. If all of their competitors were not being as disciplined in their capital allocation decisions as far as lending money, eventually they would run into trouble. If you just continue to lend money at market rates, or perhaps at rates at which your dumbest competitor is willing to lend money, eventually you're going to go broke, especially if you don't have the operational know-how to know how to do that. So in the mid to late 90s, a number of these companies blew up. In the early 2000s, there was a number of large lawsuits against Santander that was operating in the United States, which essentially precluded them from operating anymore. And so credit acceptance has had this kind of 2-decade run since the early 2000s where they've been able to grow their loan volumes at really good rates and still be able to lend out money at attractive rates to what they would call good credits. The average person, and so sorry, you can see here on the stock chart over the last almost 20 years, if the stock chart went back further, it would probably be even more impressive. But they're one of these few companies that's been able to compound their total stock return at near 20% for the last 20 years, which is an incredible achievement. And we'll get into why that is the case a little bit later. So that's essentially the early history of the company. And that whole description kind of brings you up to where we are now, although there have been quite a few developments in the last 2.5 years. So aside from their lending part of their business, which is quite programmatic at this stage, there aren't a lot of the capital allocation decisions as far as lending money are mechanical. There's another part of their operations, which is the controversial part, which is the collections and repossessions part of their business. And this is things that have got them in trouble in the last couple of years, where their collections have been too aggressive for certain state regimes. But basically, they run an incredibly efficient collections operation, which is another part of the puzzle as to why they've been so successful, where so many other people have not been as successful in this industry. Many people have gone by the wayside over the years. Like there's even a Buffett quote, which essentially states that anyone can lend money. That's not the difficult part. The difficult part of this business is collecting. So you can go onto YouTube and you can see like a very large number of credit acceptance customers complaining about the collections. Now, it's just a part of lending money and a part of human psychology is that if you borrow money from someone and then you fail to repay, like normal human psychology will try to paint yourself as the victim and the person who lent you the money as the like the predatory lender. Now, that might be true in some cases. I suspect it's not true in the vast majority of cases. And this is an incredibly well-regulated industry where, all these understandings need to, are all written out in black and white at the point of purchase. So I'm usually a little bit skeptical about a lot of them. Credit acceptance has a number of technological, you could call them innovations if you wanted to, basically where they're able to stop a car if repayments are made. So you can go onto credit acceptance, you can see people who have missed payments on their loans and they're trying to restart their car. And when they try to turn the car on, the car fails to start and alarms go off, etc. The other thing credit acceptance is able to do is to track these cars. So obviously pre-telematics, if somebody didn't repay their loan, you could know the general geographic area of where they were, but you'd have to kind of track somebody down, wait for them to leave their car, and then kind of repossess it. A very labor-intensive exercise. They've taken a number of steps to kind of turn this all into a pretty sleek process. And so essentially, over the years, you're probably looking at 1/4 to 1/3 of these loans not performing eventually. And so that would be pretty crazy. In most markets, if your non-performance rates are 25 to 33%, you might wonder how somebody can earn a good return lending money to an end market like that. And the bottom line is that they're charging very high rates on these loans. So these people who are borrowing to buy themselves a vehicle and are funding it through a credit acceptance loan typically have FICO scores like capped out at 560. If people aren't familiar with a FICO score, it's a credit rating, an individual credit rating in the United States, which is, a predictor of credit performance. So these are people who are precluded from the usual finance system. They're deemed subprime, and most financial institutions won't touch them. The credit rating system in the continental United States is very punitive. Like, quite often if someone's going to rent you their home, or you're even going to apply for a job or go to college, something like that, your credit score is taken into account in all those kind of decisions. So it's a very, it's almost China-esque, if you will. You've kind of got your social credit rating in China, and you've got your FICO rating in the United States. Now, these people can't find financing anywhere else, and so they need a vehicle to operate successfully in society, and so they're going to charge an incredibly high rate for that. Now, that varies on state by state. In some states like Massachusetts, the annual interest rate you're able to charge on a vehicle is about 20%. In some states, it can be as high as 30%. Obviously, in the past, those rates could have been even higher, but most states have regulated a capped interest rate. Now, so at least with these high default rates, part of it is being ameliorated by the quite high interest rate that credit acceptance and their peers are able to charge. On the other hand, you do have the asset, you have the asset value as well. So the used car, after it's been sold, and then someone defaults on their loan for that car, and then you're able to repossess it, that car is basically put directly back onto the market and sold right away. That process typically takes about 5 or 6 weeks, so it's a very quick turnover process. And the price that they're able to get it at auction is deducted against what the customer owes, and then the balance is still outstanding. And so, that debt does follow them around. But you can see those two things, the high interest rate and the high interest rate and the ability to repossess the asset quickly and then sell it makes up for those two things. The other part of this, which shows operational excellence, is a credit acceptance's willingness to decrease its loan volumes when profitable loans become scarcer, which has certainly been the case in the last couple of years. And we'll talk about that a little bit later, but a number of the bears on the company cite that as a reason for their business essentially imploding. Whenever there is like abundance in a certain end market, the ability to not have to participate in the volumes at uneconomic rates is a sign that this company is going to be around a lot longer than its peers. And it's been multiple cycles over the years where this has happened. Ironically, in very hard economic periods, the company writes, so it's obviously not harvesting cohorts at rates they expected to in tough economic times. But in tough economic times, the number of people who move from near or prime into subprime, they move down the credit credit rating scale. But a ton of people move down because they might have lost their job or something like that. And these are probably high skilled people anyways who are going to move back to prime when economic times are better. Those times provide an abundance of people who are going to need subprime financing, but are probably much better credits than what the market is anticipating at that time. So that was like 2008. 2008, 2009, credit acceptance was able to write loans to customers that were incredibly profitable. And because interest rates are capped in a whole bunch of state, profitability is kind of much more correlated to someone's ability to repay over the life of a loan. And the life of the loan, it has changed a little bit over the years, but it's essentially anywhere from 2 years to 3 years, so 24 to 36 months. So credits themselves are kind of, they get turned over pretty quickly. The other thing, which was part of the Massachusetts Attorney General's case in 2020, was that credit acceptance was flaunting the usury laws, so the maximum interest rate chargeable, by charging people all kinds of fees for ancillary services. So there are things that credit acceptance pulls where, say for instance, you don't have a computer or access to the internet, which sounds pretty crazy now, but not everyone had, 100% of people do not have access to the internet even now, but certainly was not the case 10 or 15 years ago. And if you are in a long-term, like you're a poor credit over your life, the likelihood that you have access to a good computer or even a computer or perhaps even a mobile phone is lower. And so a credit acceptance would charge customers for things like, if you wanted to know what the balance of your loan was, you'd have to call them up, and then they'd have to send you a paper copy of your accounts. And so they would charge money for sending out these copies. And you can see how all those things can be pretty controversial. Like, let's say you're a very low income person and perhaps you're couch surfing or something like that, and you don't have a registered address, or your registered address has to keep changing for whatever reason. And, credit acceptance is sending out, all your balances because you want to know how much money you owe. And every time they're sending out a paper copy of your balance, they're charging you $50. I think it varies a little bit by state, but they're charging pretty hefty fees for sending these things out. And so those fees get tacked on, to your principal. They're accruing 20-30% interest a year, so you can see how that can all snowball. And so that's another way that credit acceptance was able to, generate very high margin revenue out of their customers. So in terms of the dynamics of their operations, like, it's a very slick machine. It's basically all mechanical. And the other thing that Brett Roberts did when he took over was sort of, if you read the early annual reports from the 2000s, it almost reads like a Warren Buffett-esque type letter, talking about a margin of safety, talking about efficiency in their capital allocation, trying to be rational, all those kinds of things, which boded fairly well. And usually when people try to imitate Buffett ostentatiously in their IR documents, it's kind of like a red flag. But these guys did it pretty well, very well, in fact. And so that kind of brings us up to COVID. COVID was a very interesting period for the business. It was completely unprecedented what happened. So obviously, as COVID hit, you had these very large share declines. So from the kind of middle of 2019 all the way to the bottom, it was over a 50% drop. I can still remember this actually seeing the declines. And so essentially, as everything closed down and people were no longer able to go to work, people being furloughed, obviously the delinquency rates, people were expecting them to absolutely surge. And that was certainly the case for the first couple of months, but then obviously the monetary stimulus came in. The monetary and fiscal stimulus came in, and then there were various reopenings, and the whole environment changed dramatically. So essentially what happened was, you had the fear of delinquencies, then you had very large, then you had some quite profitable business written in 2020. And then as the monetary and fiscal stimulus came on, the performance rates of the books written in, I believe, 2018, 2019, 2020, and 2021, so loans written in those years performed at rates that are much higher than what the company expected, and certainly much higher than historically observed. So a typical performance rate, again, like I've said, is about 66 to 75%. That's the percentage of the book which performs in any given year. And so these cohorts which had outstanding loans and were receiving cash directly into their accounts were repaying. And the other dynamic, which is quite ahistorical, don't think anyone's ever witnessed it happen before, was the value of these vehicles. So like I mentioned, with these loans being guaranteed, the value of the loan being backed by a vehicle, those vehicles, the value of them skyrocketed. So naturally that's going to increase the credit quality of all of these loans. And so, depending on your circumstance, you might have had an existing used car, the value of that used car went up. So you could sell it at a profit, repay your loan, buy a new car at a higher price. And so obviously that was a good thing for people who had kind of bought in that time period. You can see even since about 2014, 2015, the value of cars has been kind of going up ever so slightly. And then during COVID, due to the myriad of factors that people would be familiar with, basically, the value of cars doubled, which is incredible, a really incredible thing. And so obviously that was quite good for the company. They earned much higher earnings than would have been expected historically. And so this resulted in the company doing kind of enormous buybacks. So I was quite shocked at the beginning of 2021, they were kind of repurchasing 3-4% of the company's outstanding shares per month. And then recently we've seen the company repurchasing as much as 15% of the outstanding stock in a quarter. So that's a dynamic which is really incredible about the business as well. Now, stock prices are always forward-looking, so there's always anxieties with these companies about, how their loan book is going to go forward. Now, the dynamics of what are important as far as factors which inform the performance of the business. Obviously, one is the performance of these loans. Now, performance has been trending down for the last 5 or 6 years. And the company states that the reason for this is increased competition and an abundance of capital, which is almost certainly true. Interest rates have been very, very low, and capital has been extremely extremely abundant. So naturally, new entrants, new players will enter the market. Existing participants will perhaps lend at less profitable rates over time to grow volumes. And so obviously credit acceptance in those circumstances would be, even though they're still funding profitable loans, they're not as profitable as they have been in the last couple of years. And so that's certainly one dynamic. The other thing which informs performance is loan volumes. So loan volumes is kind of forward-looking in that it will inform it will inform the future expectations of what this company thinks that they can earn. Now, loan volumes kind of year on year have been declining at pretty precipitous rates. At the sort of halfway through last year, the company announced like almost a 40% year-on-year decline in volumes. I think that was followed up in the next half by kind of 25%. So the number of loans that they've been writing over the end of the pandemics, the 2021, beginning of the 2022 calendar year, have been much lower than in previous years, and it kind of makes sense. Like we were looking at the Manheim used car index just before. Come on. And so if you're writing a certain number of loans at, say, 140, 130, 125, and then you're writing loans as high as 225, or perhaps like an average weighted price of just below 200. So the value of the car, would obviously be the numerator. Yeah, so is in a relationship with the number of loans, depending on the price, especially if that price has moved dramatically higher. So if the cost of the car is 2x what it was 12, 24 months ago, somebody's ability to purchase that car, especially if they're in that low FICO score range, it's kind of like the same amount of money still in, even though there's a dramatically more amount of money in the system, which is causing, part of the reason why there's inflation, all else kind of being equal, if the price of the car has doubled, the number of loans that you're going to write in the subprime sector are probably much lower than that. So that kind of corresponds in that sort of 40 to 25% off kind of range. But there's no doubt that the pullback in volumes is probably also informed by the profitability of the loans. So credit acceptance is no doubt making a determination that that a greater number of people applying for these loans are no longer worth it due to all the capital in the system. And so again, that's a headwind for them. There's no doubt about that. But certainly the ability to pull back on volumes when they are looking to, when they're basically looking out at the market and saying it's uneconomic for us to lend this money, that's a disciplined thing from my perspective, and it's a long-term competitive advantage, especially over these long cycles. You see, a vast number of players either having to go out of business because they've lent money at uneconomic rates, or their collection practices are actually corrupt. That's been a huge left tail risk for operators like this. So COVID's been, even though people like to say it's like the best environment, I would say it's actually been a very challenging environment for credit acceptance. Certainly good for the last couple of years of cohorts performing at much higher rates, and so the company's earning a much larger amount of money than what they thought they were going to, and that excess capital, because they haven't seen the profitability in the marketplace of lending, all of that capital has basically been put towards share buybacks, and they repurchased a tremendous amount of the outstanding stock since the beginning of the pandemic. It's probably something like 35% now, which is a pretty remarkable number. So that kind of brings me on to capital allocation and how they're financed. It's an interesting setup. There's been a number of these subprime businesses that also do their own collections, which have been quite good from a total stock return perspective, because the market penalizes these companies for what they perceive as unethical practices, etc. And I'm not really going to make too many determinations about that, about whether their collection practices are too aggressive, or if they're taking advantage of their customers or something like that. They've been operating for over basically 50 years now. And there are just, some very stark realities about lending money in this space. And that's, if you want to survive, basically it's got to be lent at, what is perceived at almost usurious rates. And you've got to be incredibly aggressive with your collections to survive. And those are just realities of this industry. But so they have this perennially low valuation. Even if you look at the moment, credit acceptance is trading on, I think it's like a 7 or 8 times earnings multiple, which has kind of been where it's been trading for the last couple of years. And it's traded on these, single-digit price earnings multiple forever. And so basically what that allows the company to do is to retire a tremendous amount of stock at low prices. Now, a lot of people will question whether price earnings ratios are the correct metric to value a company like this. Quite a lot of people look at it on a price to book basis because it is a lending business. That's certainly one way to go about valuing it. Credit acceptance does sell a large portion of its loans onto investors. So they're not carrying the entire loan book themselves. It's not held directly on their balance sheet. But ultimately, I would say that you'd value a company depending on the cash that can be pulled out of this business. Now, this business is essentially returning all of its capital to shareholders. It's just like a buyback machine. And under those circumstances, is price to book really the right circumstance to value a company like this? It's probably, a decent metric to, gauge the performance of the book. But, a lot of those concerns kind of get obviated when it earns incredibly high margins and then returns all that capital to its shareholders. It certainly is something that's not taken into account by the bears. And so, yeah, they're able to close all these ABS offerings. Certainly hasn't been a problem. None of them have failed. One of the interesting things that people like to bring up about the company is that during the subprime crises in 2008, 2009, subprime auto ABS basically didn't even miss a beat. And the reason for that is that people need a vehicle, which is what I mentioned at the beginning. People need a vehicle to get to their job. They need it to get around and basically, live a modern lifestyle. So, cutting spending on your car or defaulting on your vehicle is perhaps one of the very last things that you do before, actual bankruptcy. You'd probably be more likely to walk away from your own home, which was certainly the case in 2008, 2009, 2010. Plenty of people just walked away from their homes, started renting instead, living with their parents, living with their brother or sister, whatever. But you'd still need a vehicle to take your kids to school. You'd still need the vehicle to get to work, etc. So that's a very interesting dynamic. The fact that they're retiring just a tremendous amount of stock every year. One of the things that differentiates this business from a lot of their competitors is the incredibly high margins that they earn on their revenues, which is their typical competitor runs very low margins. And it's for all the reasons that I mentioned. These guys are they're lending out, to their most profitable loans first. And then below a certain level, they're not lending any additional capital out. They don't feel the need to grow their volumes all the time to satisfy shareholders or what have you. They're lending out money in quite a rational way. Obviously, they've got incredibly efficient processes for the operational side of the business. And you can see that in things like their headcount. It's very steady. Basically, the times that they will increase headcount is for sales. So that's getting the credit acceptance platform into more used car dealerships. And, so to grow their sales, they invest in salespeople, which, most companies will do that if they want to increase their business. But they're very disciplined with things like that. It's probably a decent thing to talk about the ownership of this company before. So I talked a bit about Don Foss founding the company many years ago. Don Foss is still alive. Interesting character. He is also a major player, I believe, in the AMC GameStop like the gamma squeezes that were happening at the beginning of 2021. He's like a major shareholder in both of those companies, which is interesting. I don't know how he found his way into that. But Don owns a very large block of the shares, and so does his family. So he's got two daughters, and Don himself, he's getting on in years. You can see that he's 77 years old. He's also got quite a lot of health problems. He's like a morbidly obese guy. And if you look at any of the videos in the past, like the promotional videos and ads that he did for credit acceptance in the 90s, he was a obese character then too. Yeah, look, here's the GameStop stuff. Pretty funny. So he owns a very large block of the shares. So does his daughters. And they are constant sellers of the shares. So you can see here, Don Foss himself, or his annuity trust, owns almost 12%. Him personally owns 22%. See his daughter there, Jill Foss, owns 5% of the company. And you can see these guys, they're just, they basically every quarter are selling down their stock. He's getting older, does not work in the company anymore. He's no longer the chairman of the company either. So he doesn't have an operational role, and he has got a lot of health problems. So obviously he is, needs the liquidity for reasons other than he thinks the company is going to zero. It's probably the exact same deal with his family. And it's probably, some kind of need to diversify that, they would have, these are not professionals or finance people. They're probably getting advice from financial advisors, accountants, lawyers, etc., to perhaps sell some of their stock to diversify their owning. So I don't, their holding. So I don't really, I don't care too much about what they're doing. There's been a number of pretty concentrated investors in this stock over time. So one is certainly Ruan Cunniff and Goldfarb, the Sequoia Fund. They've been selling shares recently. A lot of people were selling stock kind of at the 700 range when it was quite high. Prescott General Partners. So this is the investment firm run by Thomas Triforos. Now he's not a super well-known name in finance, but he's quite a legendary value investor. He runs an investing course at Columbia. I think he did that in the past. He still might do it. And he's been a major shareholder and board member of this company for a number of decades. He's also one of these pivotal people who brought in this kind of margin of safety / rational capital allocation decision with Brett Roberts 20 plus years ago. And he's the one basically running their buyback program. Now you can see he's actually sold a considerable amount of the stock in the last quarter, almost 50% of his holdings. And his investment partnership, which I don't believe he runs personally anymore, is also selling down its holdings, but you can see there it's like 50%. It's over 50% of what they own. So those are interesting dynamics. Quite a few people are probably familiar with Rob Vinal of RV Capital. He's been a large shareholder in the company. I think it's probably a third of his US holdings, so maybe 20–25% of the value of his fund. And he's been buying quite a little bit. He's been buying a little bit more. And you've got guys like Brett Roberts, so the previous CEO. Mostly these were shares acquired over his tenure as CEO through stock grants for performance. So he owns, 90, almost $100 million worth of the stock. So it's a fairly concentrated base of owners. A number of them are selling periodically for the reasons that I mentioned. And you've got this tremendous buyback basically happening every quarter as well. So it's an interesting dynamic where there's not a large float of the market. You've got a number of concentrated investors who, have not always been selling. Typically the people who have been selling a little bit off are, Don Foss and his family, plus executives who sell their stock for probably tax reasons. You can see here that Brett Roberts hasn't been selling any stock, and he's probably the largest former executive who owns stock in the company. And so, the question for anyone looking at this company now, and I'm certainly not buying, but I'm not selling any of my shares either, would be the prospects for the company looking forward. If you look at any of the reported, data, the decline in the used car index, the scarcity of capital, the declining performance of the loan book, I mean, none of these things look particularly rosy at all, which is why periodically this company has looked like quite a good short. If you've been on Twitter enough and you just search up the symbol essentially all the posts on Twitter are just like for always, as long as I've been on Twitter since 2017, people are just massively negative, bearish on the company at all times, accusing it of being an accounting fraud / a predatory lender, etc. On and on and on. Now, those short theses have not played out well for, basically 15 years. And the reason for that is these are the most disciplined operators. They're an incredibly disciplined operation, and they're incredibly profitable. They have huge profit margins, and they're able to allocate that capital very efficiently, depending on what the market's offering them at one point. So people who have been shorting this stock, and people have been on and off short it for a number of years, it's been some quite high profile shorts against it, is that you're really running against, I don't want to be arrogant about this or anything, but it's kind of like shorting the absolute best operator in an industry just because there appears to be headwinds to it at any particular moment in time. So there would have been like all kinds of moments when you could have said, Apple's going to face headwinds, Google's going to face headwinds, even Berkshire Hathaway has had several periods where they faced significant headwinds. And so, maybe you get the timing right, maybe you don't, but this is certainly not a fraud. This is not a company which is shaking down its shareholders and diluting the base. They don't have crazy remuneration policies. They're not involved in pet projects of their CEO. And so it's just, it's a very difficult thing because this is probably, if these guys were to go bankrupt, the entire industry is basically going bankrupt before them. And it's very hard to see them, even in a really catastrophic outcome where loan performance declines precipitously, and they're not able to lend out any money. It'd be very hard to see a constellation of circumstances which are catastrophic. It would basically, the entire company would need to change its whole operating thesis, ethos, which would be a very difficult thing to see, especially when you've got long-standing owners on the board, like Tom Triforis and his investment outfit, which is the largest single shareholder. And you've got people like Brett Roberts, who brought in a lot of these operating philosophies, still quite a large shareholder in the company. And you've got a number of long-term value-orientated investors who bought in because of all these reasons. And so in a very bad market, like a 2008, 2009 market, and capital becomes much scarcer, these guys are going to benefit from that, even though their existing assets, the existing loans they've written may not perform as well. Now, a lot of these bear theses rely on exactly what the Massachusetts Attorney General's case against the company was in the late 2000s, and that basically pertains to them breaking the law in a number of states. So the AGs case basically hinged on the company violating consumer protections in two important ways. And the first way was people were being contacted more times than was legally allowed. So I believe in Massachusetts, somebody, a delinquent borrower can only be contacted, I think it was twice a day. And there were selected instances where the company had contacted a person 3 or 4 times a day. So that's obviously illegal. It's against the rules. Because the case settled outside of court, it's unclear about how true that was, or if they were able to substantiate it. The other part of their case, which would have been quite a big deal, was that, as I mentioned before, the company charges quite large fees on some of the ancillary services it offers, like sending you out a paper copy of your existing loan balance. And the AG basically argued that the company, that those large fees should be counted towards the annual the annual interest rate that was being charged. So if you counted the fees and the interest rates together, which is a bit like, you know, they weren't really defining terms properly. But if you take them together, they were saying that that number, you know, far exceeds what was legally allowed. And so the rebuttal to these kinds of things, which an operator like Brett Roberts described before his departure from the company, was that in the past, the regulators in various states understood that the operators like, you know, Credit Acceptance are running a centralized collections process for 50 states. And each state has different laws. And they all have different nuances to what's allowed. So if you're running a centralized process and you've got all these nuances depending on 50 different regulatory regimes, the likelihood that you break some of the rules in each of these, you know, in any given regime at any given point in time, it's a virtual certainty. If you're allowed to call somebody 4 times a day in New York, but you're only allowed to call somebody once a day in Florida, and you have essentially the same pool of people doing collections for all of these states, then you know, people are going to get confused. They're going to make mistakes. That's just a natural part of doing what they're doing. And so in the past, the regulators were much more willing to, you know, settle these complaints, you know, directly with the company, you know, not necessarily be adversarial about it, and certainly not taking the company to court. And then, you know, kind of as the American political environment has become a lot more polarized in the last 10, 20 years, if you will. The likelihood for a firebrand AG to get elected or appointed in any given state has certainly gone up. And, you know, to score political points, these people are going to go after low-hanging fruit like Credit Acceptance. Now, in the case of the AG's case, it was settled for $30 million in 2020, which was a huge coup for the company. Many people were banking on this being kind of like a death knell for the company. And a lot of the informed speculation was looking at, you know, several $100 million being the range of, you know, what was expected as a settlement. And if you take it, if you kind of understand how much the company earns in any given year, it's probably making $300-400 million a year. So a very material effect on their income for a number of years. And so they settled this, and they've had a ton of smaller settlements in the past. The company is essentially permanently in court. There's no doubt about that. They've got a chief legal officer, and they have an incredibly efficient legal department. And, you know, there's kind of incredible stories of them keeping the regulators in various state and federal courts for 10+ years at a time. So they're basically expert in this. Suing them is, you'll pay a pound of flesh for suing them, even as a government regulator. And these guys can keep going for a very long time, a very long time. And the likelihood that any particular attorney general is still the attorney general in over 10 years from now is a very low likelihood. So that's another dynamic where, you know, a lot of these cases are being settled for modest sums, and the company kind of moves on. But the likelihood of any of these regulatory actions crushing the company are not definitely not zero. There have been plenty of examples of what I would call genuinely predatory lenders in the past being nuked by the government. Certainly the Obama administration had no problem nuking the for-profit education sector. So the regulatory right left tail outcome is certainly there. But at the end of the day, these guys make it possible for certainly a lot of the Democratic bases, the Democratic base's ability to buy a car. They make that a possibility. And I think a number of the regulators ultimately acknowledge that. And, you know, sending out of business a number of these companies, especially a long-lasting one like credit acceptance, would allow probably for worse operators, black market operators, and certainly for a period of time, it would affect some portion of the population's ability to purchase a car. I think they understand that even though the optics of what they're doing are pretty negative, at a superficial level, they are offering a valuable product at the end of the day, which is why the company still exists 50 years, 50 years on down the line. So that's pretty much the whole thing. It'll be a very interesting company to keep your eye on over the next couple of years. Certainly there's a trajectory for this business to do materially worse, especially if the factors that are outside its control continue to deteriorate. It's certainly a possibility. But I also think in this kind of environment, with capital sort of exiting the system as a whole, the likelihood that the company finds itself in a position where it's much more difficult to get a loan than it was, and the number of people to migrate down the FICO score scale is probably quite high. And these guys, are able to charge very high rates on those loans, and people will continue to need a car. That certainly hasn't changed. We're not at a level of societal development where we can have, robo-taxis, a robo-taxi fleet, taking the cost of transportation down to zero. So it's an interesting company. If you've got any thoughts, let me know. Always interested to hear what other people have to say. There's some pretty good short reports on Twitter that are worth a read to get yourself familiar with the company. Also, the Massachusetts Attorney General's complaint is a very good document outlining all of the operations of the company. It was very informative, when I made an investment in this originally. So that's quite good too. Anyways, let me know what you think.